We now expand on the accounting for liabilities and start with those created by wages. If you worked a 40-hour week at $10 an hour, you would have earned $400. But that is not what you would be paid, as taxes are withheld for income tax, Social Security tax, state income tax, etc. You might get a check for $300 or even less. The taxes are kept by your employer, and at the end of the month or quarter, they are paid to the federal government or the state. As a business, you are just a middleman for taxes that you withhold from your employees and pay to the federal and state governments. In this example, your employee earns $600. However, that results in income tax of $54, FICA Social Security tax of $38, and state income tax of $18. Those amounts are withheld and set up as a liability, as you must pay them to the Fed or state at the end of the month. Even though the total earned is $600, your employee will be given a check for $490. The taxes are set up as liabilities. See the journal entry debiting wage expense for $600 and crediting the 3 tax liabilities. The final credit is the $490 given to the employee. As you can see, when we post the entries to the ledger, we show the amounts in the 3 liability accounts that eventually we must pay to the state and federal government. At the end of the month, checks are written to pay the appropriate government agency collecting the taxes. These are credits to cash and debits to the tax payables. Here is the journal entry. As you can see, when the amounts are posted to the ledger, they zero out the amount owed. In this example, we show how we account for sales tax. Assume you buy something that cost $100. If you live in a state with a 6% sales tax, you will pay $106. All the store does is collect the sales tax from you and pay it to the state. Once again, the store is just the middleman. When the sale is made, the store would make an accounting entry that debits cash for the amount you paid, $106. $100 is credited to sales revenue, and the $6 goes to a liability account called sales tax payable. The amounts are then posted to the ledger. At the end of the month, a check for the amount of the sales tax is sent to the state with a credit to cash and the debit going to the sales tax payable account. When this transaction is posted to the ledger, it zeroes out the payable, as you no longer owe the tax that was collected by the state. We now look at interest from the point of view of a borrower. In this example, you borrow $100,000 at 6% for 2 months on June 1st. On June 1st, you get the $100,000 and sign a note promising to pay it back with 6% interest on July 31st. On June 1st, you make an accounting entry debiting your cash for $100,000 and crediting loan, note payable for the $100,000. The entry is posted to the ledger showing that you have a note payable liability of $100,000. On June 30, after 1 month, you owe 1 month's interest. $100,000 times 1/12, 1 month, times 6% equals $500. An adjusting entry must be made to record the interest as an amount that you owe. Interest expense will be debited for $500 and interest payable will be credited for $500. You don't pay any cash now. You just show that you owe 1 month's interest. Once posted to the ledger, you can see that you owe $500 interest. On July 31st, you must pay off the loan. The payment will be for the amount of the loan, $100,000, plus the 2 months' interest that you owe. You write a check for $101,000. The $100,000 plus $1,000, which is the 2 months' interest. This is credited to cash. The debits are $100,000 to the loan payable account to close out the loan, $500 to the interest payable account to close that account out from the June 30 accrual, and $500 to the interest expense account to record the July interest expense. Note, the total interest expense for the June-July 2 months is $1,000. When this final transaction is posted to the ledger, you record another month's interest expense, bringing the total interest expense to $1,000. You reduce cash by $101,000, and you zero out the note payable and the interest payable accounts. Bonds are financial instruments issued by companies to obtain cash by creating a long-term liability. The bond is to be paid back after a certain time period, such as 10 years. During the term of the bond, the issuer agrees to pay interest. After a company initially issues a bond, it often is sold between bondholders. We don't spend a lot of time in this class covering bonds, but I just want to cover the basics. Here is the accounting for issuing an $800,000 6% 10-year bond. If we issue them at their face amount, we are issuing them at 100%, or commonly called 100. If they are 6% bonds, we agree to pay the holder 6% interest per year. And after 10 years, we will buy back the bonds. Initially, we debit cash and credit a long-term liability called bonds payable. The transaction is posted to the ledger. You have recorded cash of $800,000 that you received and a liability for $800,000.